Good to see you. How have you been?
I've been keeping busy, Jeff. Lots going on in the market. Hope you're doing well too.
Yeah, doing very well. The summer's over. It was a rainy summer for most of the country, but we got in some vacation time. I hope you did as well.
We got a little bit of rain here in Southern California, which is unusual. So it's been a non-normal year, if you will.
Not normal for sure. But yeah, let's get right into it. Big news this week. We're recording here September 15th, and the UAW has set up some picket lines. And, while our GDP is much more diverse than it used to be when it comes to auto manufacturing, nonetheless, the American auto manufacturing is still a huge component of our economy. And I would love to know your thoughts on how that will ripple through America.
Yeah, the UAW strike is in some ways unprecedented. The union voted to go out on strike against all three major automakers at the same time, and that'll basically shut down production in the U.S. at a time when the big three are moving more toward electronic vehicle production. And continue to put them at a little bit of a disadvantage. But economists are forecasting that this strike could cost the U.S. Economy as much as $5 billion, and it's another hurdle to overcome as we try and get the economic ship righted moving forward.
So I guess the question would be, will we see areas of the country that have those plants directly affected, maybe tip into a recession earlier than other areas if that's the direction we're heading?
Yeah, I mean, there's unemployment, which continues to be low, and then there's striking, so you're effectively unemployed, which will affect thousands and thousands of these auto workers. And the two sides are very, very far apart in terms of negotiations. So this could be a long and pretty costly strike. We could start to see things like credit card delinquencies, mortgage delinquencies, ironically, auto loan delinquencies jump up a bit, and that could tilt some of these states into local recessions, even if it doesn't spread across the country. But you're looking at states like Michigan. You're looking at places like Missouri that have these plants that the car makers have put up, and it wouldn't be a huge surprise because this workforce comprises such a big part of the economy in those states, to see those states start to struggle a little bit.
Interesting. So let's transition into where we're seeing home sales overall in the United States today, and sort of what's trending. In previous conversations that we've had, we've gotten granular on certain areas, and we may do that again today. But let's start overall, 30,000 foot. What are we seeing today in home sales?
Well, July was the 23rd consecutive month where existing home sales were lower than they were the prior year. I'm not sure if that's a record, but it's a lot of months in a row. And if January hadn't been so bad in terms of home sales, we also would be seeing a trend where every month's home sales are actually lower than the prior month. So that's happened from February through July, which is the most recent month we have full data for. At the current pace, we're probably looking at just over 4 million existing homes being sold over the course of the year. And if that's the case, it'll be the lowest number of homes that we've sold since 2009, which was right in the heart of the Great Recession. So it's a pretty big drop off. Last year, there were about 5.2 million homes sold. The year before that, there were about 6.1 million. So it's a fairly consistent drumbeat on the path down right now.
That's truly an amazing number. And I guess we're chalking that up mostly to the higher interest rates, not only for new home buyers, but just as importantly, the reluctance of folks who locked in those low rates 2-3 years ago to put their home on the market because they don't want to open themselves up to securing a new home at a much higher rate.
Yeah, there are two significant headwinds that are affecting the market right now, Jeff. One is lack of inventory available for sale, which we can talk about in a minute. The other major headwind is affordability. And there's so little inventory on the market right now that what inventory does come up is being bid upon. You have competitive bidding by people looking to buy these properties, and they're buying these properties which are pretty expensive with 7.5% mortgages. So it's a real challenge for your average home buyer to go find something that they can afford. Pricing has been really interesting too. If you look at existing home prices, according to the National Association of Realtors, the median price is actually up year over year. Last year was the peak year in terms of pricing, and home price appreciation declined all year. It actually went negative for a few months, but then in June and July it started to tick back up, and we're actually above water now. So prices, whether you're looking at the NAR numbers or numbers from the FHFA, are up a couple of percentage points from last year. So that combination of record high prices and financing rates that are twice what they were a couple of years ago is just making it really difficult for people to be able to afford a property.
So that's interesting that we saw a slight tick down earlier in calendar year 2023, but now we're ticking up. But we just got done talking about how we're going to have the lowest number of transactions. I would think that the volume was picking up, and maybe that's why prices were rising, but that doesn't seem to be the case.
No, we're in a normal market, we would have about a 6-month supply of homes available for sale. If you look back at that Great Recession we were talking about earlier, heading into that, we had about a 13-month inventory of homes available for sale. So about twice as much as the market could absorb. Today, we're looking at about a 2.5-month supply of homes. And that's even with demand being weaker than it normally is. So we're under half of the number of homes we would normally want to see in a balanced market. And as those properties come to market, if they're priced appropriately, there are buyers on the sidelines waiting to pounce. But it's a supply and demand equation, Jeff, with limited supply and at least steady demand. You're seeing prices go up even as the volume of sales go down. You had talked about the difficulty for people with current mortgages to move forward because they don't want to trade in that low rate for a higher rate. And what's happened is something that economists refer to as rate lock, which means somebody basically gets trapped in their home by having this very, very favorable mortgage rate. And I don't think anybody's crying for them because with inflation at 3-4%. And you're sitting on a 3% mortgage, you're actually doing pretty well if you fast forward 30 years on your monthly payments. But the impact of people having these low rates is keeping inventory numbers artificially low. If you don't have to sell your house today, you're probably not going to. You're going to wait for market conditions to improve. And the math is really what makes that choice pretty easy for a lot of homeowners. If you're sitting on a 3.5% mortgage and you sell your home today and buy another house for exactly the same price, you just basically doubled your monthly mortgage payment. And very few people actually buy a house for the same price as the one they sold. So the reality is anybody that would sell a house today would wind up buying a more expensive one with an interest rate that's probably 2, maybe even 3 times higher than the rate they currently have. And that keeps thousands and thousands of homeowners on the sidelines.
Interesting. So certainly we're seeing some new construction, especially from the larger nationwide builders that have very diversified operations, not only from geography, but also from their business plan, meaning, they own their own mortgage company, they own their own title company. They're able to roll some of these fees in to help the new home buyers maybe defer some of the interest that they would have to pay if they were going direct to a lender. What are we seeing from the new home builders, and is this going to continue to roll?
So the new home market is a little different than what we're seeing in the existing home market. On On one area in particular, we're seeing a big difference in pricing. The median price of a new home sold today is down about 16% from peak. And if you remember, we were talking about existing home prices, they're actually up a little bit from last year. That doesn't mean that the builders are discounting existing inventory by 16%. What we're seeing is the builders are building smaller homes. They're building homes that cost less per square foot to construct. So they've adjusted what their business model looks like in order to accommodate these higher financing costs. The other thing that we're seeing is builders are negotiating with buyers. So we're seeing a little bit more buying activity on the new home side. But builders are coming to the table with cash where they will pay points to buy down mortgage rates for a buyer. They're discounting, they're offering upgrades to the properties that they're selling. So if you're a Pulte or a Toll Brothers or another construction company, another builder, you're incented to sell these properties because if they're sitting there vacant month after month, they're costing you money. And so you'll negotiate, you'll deal, and we're seeing that actually happen with new homes. If you're an existing homeowner, just the opposite. If you don't have to sell and increase your monthly costs right now, you're simply not going to. You're going to wait for market conditions to improve. So the net effect of all this is we're actually seeing new home sales outpace last year's numbers. So at the beginning of the year, I was forecasting that we'd see somewhere between 600 and 650,000 new home sales. Looks like we're going to be closer to 675, maybe even touch 700,000. So it's a relatively small percentage of overall home sales, but the new home market is doing better, relatively speaking, than the existing home market. Ironically, Jeff, the other reason they're doing better is there's properties to sell. So where on the existing home front, you're looking at inventory levels that are less than half of what we'd normally see. In the new home market, inventory levels are just about back up to normal as the builders have increased production. And so there's inventory there for people to buy. And if they can't find an existing home, they go buy a new one.
Yeah, that's super interesting. The other thing that I've certainly been reading about is the profitability of the new home buyers, especially the ones with scale, is pretty strong. So even though they've adjusted some of the size of the offerings that they have, it sounds like the prices that they're charging are compensating for the homes that they're selling, even though they're a bit smaller and they are contributing some money to buy down rates and whatnot. Profitability is strong, which bodes well for the future of new home construction.
Yeah, it's a great point, Jeff. The fact that the median price of a new home is down year over year doesn't mean they're giving away any of their housing stock. There are willing buyers for whatever the builders bring to market, and they're able to make a healthy profit on the properties that they're bringing in. In fact, one of the interesting things I've heard this year is that for the first time in a while, we're actually seeing investors go buy directly from new home builders. And that's something you don't typically see. These are clearly not going to be fix and flip investors because it'd be almost impossible to make those numbers work. But for investors looking for a rental property in certain markets, if there's end of development inventory still available from a builder, very often that's the best property that investor can get their hands on, and they can make those numbers work because maybe they can charge a little higher rent for a brand new house.
That's interesting. The investor's appetite has not diminished whatsoever, and the ability to go to a new contractor or a larger scale developer and negotiate maybe a multiple purchase deal, and then pencil out the rents and then begin to build the portfolio in a different direction than you have in the past. That's some super interesting information. Let's transition actually into some investor activity. What are we seeing data wise on investors wrapping up the third quarter here?
Most recent data I saw was second quarter data from CoreLogic. And the way they analyze the transactions in the marketplace, their estimation was that in that quarter, about 26% of all purchases were made by investors. And I believe that's probably understating the amount of activity actually going on with investors. I don't say that because I think the CoreLogic data is inaccurate. I say it basically just because of what they count as investor purchases. The way they track their data is that any buyer with some sort of corporate designation in the name, so an LLC, an LP, a corp, counts as an investor purchase. But we all know that there are a lot of smaller investors out there who don't have that kind of designation in their name, and are buying properties as investment properties as well. But still, more than a quarter of all residential purchases in the last quarter were made by investors. What I found really kind of fascinating about that was, the headlines are still all about Wall Street buying up Main Street and gobbling up all these properties and keeping home buyers at bay. And if you look at the numbers, nothing could be further from the truth. Over 90% of those investor purchases that CoreLogic cited were made by small and medium-sized investors. The biggest of the big investors combined were purchasing less than 10% of those properties. So it continues to be a market driven by the mom and pop investor, that investor who has somewhere between maybe 1 and 10 properties in their portfolio, or maybe fixes and flips a handful of properties over the course of the year. But they're serving a very, very important role in the housing ecosystem. The fix and flip investors are bringing inventory to market that otherwise wouldn't be available for traditional home buyers. And the rental property investors are making homes available for people to rent in neighborhoods that maybe they can't afford to buy a house in. So really, really important not to lose sight of the very valuable role that investors play in the housing market.
That's well said. It's interesting, some of the statistics that I've seen I think it was from calendar year 2022. If you were to aggregate all the single family rental homes available in the United States, just over 50% is a portfolio of 2 or less, basically meaning it's a mom and pop investor that own an extra house that they rent out. And who knows how that house was acquired? They could have moved, kept the old house, could have had a family member that was gifted down. Who knows? But that really helps solidify what you're talking about when it comes to who's owning the rental properties in the United States.
Well, the industry's taken a look at ownership rates in the single family rental market, and consistently comes back with a report that says that over 90% of single family rental homes are owned by landlords who have fewer than 10 properties. There's a middle tier that owns a certain percentage. And then if you get to the institutional investors, the big guys, Invitation Homes, American Homes for Rent, Amherst, collectively, that whole group owns about 3% of the inventory that's out there. But don't take their word for it. Freddie Mac did a similar assessment on their own, and they came in at about 88% of single family rental owners owning, I believe it was less than 8 properties. So the numbers speak for themselves. A lot of the big institutions who are interested in single family rental properties have moved some of their budgets into build to rent activities. So they're actually working with the new home builders and building, small communities that are made up entirely of single family rental properties, not multifamily buildings, but little communities, which, in another time might have all been kind of starter homes available for sale, but in this case are all being built specifically with the idea of renting them out. And I think, if I were an institutional investor, I probably would have been doing that a long time ago, because it gives you much more control on pricing, much more price certainty, gives you a better idea of the quality of the asset that you're going to be renting out, certainly makes things easier from a maintenance perspective. So I think we're going to see a little bit more of that moving forward. And that's good news again for small investors, because that's, that much less competition. If you're a small to mid-sized investor in today's market, interestingly, you probably have more opportunity than you think, because your traditional home buyer is very, very often sidelined today by the high cost of financing and the high cost of the properties themselves. And your institutional investors appear to be keeping their powder dry or moving into new construction instead of competing. So less competition for those investors who are normally looking for a property here or there to either fix and flip or turn into a rental unit.
Yeah, and are we seeing any sort of geography shift in where investors are buying today? Certainly we've discussed over the years that, it's sort of the smile across the United States, everything below the smile, the southern, the warmer states continuing to benefit. Are we seeing any change in that as these interest rates have sort of hampered the ability of new listings?
That's a great question, and we have seen a change in geographic focus for investment dollars over the last year. The smile states, the sand states, whatever you want to call them, have typically been kind of the purview of fix and flip investors. And we've seen fix and flip activity slow down as home prices have slowed down, but finance costs have gone up. So we're seeing a little bit less investment activity in places like California and Arizona. On the other hand, we're seeing a move by particularly rental investors into the Midwest and the Southeast. And that makes a lot of sense because if you're buying a property in Iowa or Indiana or Missouri, you're going to be able to buy a property for less money, and it's probably a little easier to make that rental income pencil out profitably than if you're buying a home in California where the median price of a house is $860,000. Just a limited number of renters who are going to be able to pay what you need to charge in rent to be able to make that work. So yeah, we have seen investment activity move toward the Southeast and particularly into the Midwest as financing costs have gone up.
Well, that's interesting. And, for the investors enjoying our conversation today, I think that's a huge takeaway, is to begin to think about looking in areas that you may have overlooked before as the opportunities are availing themselves in maybe some of those underthought markets, right? Whether it be Indianapolis, Columbus, Ohio, certainly Kansas City, some of these very strong economies in those areas where the housing demand remains unabated.
You're making a great point about where investors should be looking. And one of the things that has continued since the COVID pandemic is a migration out of high cost, high tax areas into lower price markets. And this is particularly true for folks who maybe are tech workers who literally can work from anywhere. And they are voting with their wallets and moving into markets like Columbus, Ohio, and Kansas City, where there are sort of small tech hubs available, but the cost of living is so much better for them than coastal California, the Pacific Northwest. So the two things I always counsel investors on is, take a look at population trends and take a look at job growth. And if you're looking at a market where population is growing and where jobs are growing, odds are that's going to be a pretty healthy housing market. Columbus, Ohio has been one of the best kept secrets really in the housing market for the last 4 or 5 years. A very, very stable workforce, growing economy. Intel just announced they're putting up a facility there, which will accelerate things even more. But we're seeing a lot of investor activity in Ohio right now, to your point. And actually, it's interesting you picked up Kansas City too, because that's another area that we're seeing both population growth and investor activity. So it's a good time to be broadening your horizon beyond your local marketplace. And that's a big step for a lot of investors, because the majority of small investors tend to focus on their own hometown or something more or less adjacent to where they live, kind of keep it within driving distance. But today's realities, today's market dynamics suggest maybe it's time to broaden those horizons.
Without a doubt. And, certainly investors today are thinking about, when interest rates are going to change and things like that. And, I'd love to dive a little bit into the CPI and how the Fed thinks about housing and what it makes up of the CPI and how they're attempting to quash the inflation. I think it would be helpful for the folks on the call today to sort of take a step back and understand what the Fed's thinking, especially when it comes to the CPI and housing, and how that pot of soup sort of gets made. And let's dive into that a bit, Rick.
Well, there are over 200 categories that the Bureau of Labor Statistics looks at when they're putting together the Consumer Price Index, the CPI. They break them down into 8 major groups: food and beverage, housing, apparel, transportation, medical care, recreation, education and communication, and then goods and services. And the 3 biggest that they look at are food and beverage, transportation, and housing. And housing has been one of the major culprits in driving the CPI up. And in my view, will be one of the heroes that will ultimately bring the CPI down a bit. It did go up year over year and month over month in the most recent report. And it was expected to go up, but it went up a little bit more than people had expected. And I believe that was almost entirely due to an increase in gasoline prices. So the energy component went up pretty significantly. When I say I think that housing will be the kind of the hero coming to save the day with bringing the CPI down, this is an anomaly in the data that I don't pretend to understand. But the CPI data that is used to figure out inflation rates is lagging by a year. So they're always using last year's data. And the primary component they use for housing is actually rental rates. They throw in something they call a rental equivalency to kind of guess what you'd be paying in rent for a house that you have a mortgage on. But it's driven by rental rates, and it can be as much as a third of the CPI, housing costs. If you look at rental rates a year ago, they were still going up 8, 9, 10, 12% on a year over year basis, and have been coming down steadily ever since. Right now, if you look at year over year rental asking prices, they're either slightly negative or just barely above zero. So as the more current data works its way into the CPI analysis, it will have the effect of bringing that CPI number down, which will get us closer to where the Federal Reserve wants to get in terms of overall inflation. And we should point out, Jeff, that the CPI number is slightly different from from some of the top line inflation numbers we get from the government. So the Federal Reserve is watching both of these, but they pay, I think, a little bit more attention to the CPI.
Well, that's very interesting. And it is surprising, I think, just how much housing affects that number. And the way they calculate rent, I'm not so sure how accurate that really is.
Jeff, you're suggesting that numbers put out by the government are less than perfectly accurate? I'm shocked. Shocked, I tell you. I feel like the gendarme from Casablanca right now. I'm shocked. Here's your winning, sir. Yeah, it's no, I believe the economists working for the Fed may be the only ones on the planet who don't factor in the lagging value of housing numbers. But the fact that they do account for such a high percentage of the CPI actually sort of makes sense if you think about it. If you're taking out a mortgage right now, you're expected not to spend more than about a third of your income on your monthly mortgage payment. That's kind of been the rule of thumb for many years, although you can get loans where that debt load is as high as 43% from some lenders. But if in fact most U.S. households are spending a third or more of their income on housing, kind of makes sense that CPI would kind of follow suit. So I do understand that logic. I just don't understand the logic of using year-old data.
Makes sense. So let's talk a little bit about the numbers and how the Fed is going to be looking at these and the data that we're seeing on housing prices. Low transactions, high dollars. Really all anybody really wants to know is, are interest rates, especially for 30-year fixed mortgages, close to a peak, or do we have more to come?
I'm on the optimistic side of that question, Jeff. I think we're either at a peak or we're really, really close to it. Because I think the Fed is really, really close to stopping its rate hikes. And historically, according to Freddie Mac, every time the Federal Reserve has stopped a Fed funds rate hike cycle, mortgage rates have come down. So assuming maybe there's one more rate hike between now and the end of the year, but I'm hopeful there is not. We should be at the high end of this mortgage rate cycle. Now, keep in mind, I'm clearly going to have been wrong with something I predicted earlier this year. I said earlier this year that I believe we'd be getting back to 6% or even below 6% mortgage rates by the end of the year. But I didn't expect the bonds market to go sideways when it did. And so the yields on bonds, 10-year bond in particular, have jumped up pretty significantly over the last few months. And that has a domino effect on mortgage rates. So really, we're probably going to be stuck around 7 until the Fed does take its foot off the brake and say, okay, we're done raising rates. And then the market will have a chance to reduce the amount of interest that it's built in to cover risk and volatility. A lot of the reason rates are as high as they are today is because nobody was really sure what the Fed was going to do, how high they were going to take the Fed funds rate. But if the Fed were to say today that they're going to stop raising rates, but they're going to keep things where they are for probably a little longer than people were expecting, I think you would start to see mortgage rates gradually come down. I do believe we'll be back in the 5s sometime next year. It might not be until late next year, but once we get down below 5.5% mortgage rates, and that will happen at some point, I do think you're going to start to see more properties come to market that will have given those homeowners time to build up even more equity, which to a certain extent will offset the higher mortgage rates they're going to have to pay. And I think we'll have a chance to get back to a market that feels a little bit more normal.
You know, one of the things that I've studied in looking at historical data is as the Fed reaches the peak of their interest rate cycle, the need to reduce the Fed funds rate is not necessarily needed to have mortgage rates begin their slide in the other direction oftentimes far in advance of the Fed actually beginning to lower rates. Any thoughts on that?
Yeah, you're right. I'm going to put an asterisk at the end of that comment. You're right in that we don't need to see the Fed start to reduce Fed funds rates in order for mortgage rates to come down. And I agree with you. Those two things are decoupled, and we might start to see mortgage rates tick down a little bit slowly and gradually before the Fed starts to lower rates. The reason I put an asterisk at the end of the sentence there is because typically we haven't seen the Fed go from 0 to 5.5% Fed funds rates in a year. And if you're looking at a Fed fund rate of 5.5, it's hard to imagine mortgage rates on a 30-year investment being lower than what your overnight borrowing costs are. So there's probably a point that mortgage rates won't go below until the Fed starts to reduce the Fed funds rates. But I agree with you that I think we'll see mortgage rates start to tick down before the Fed does reduce the Fed funds rate.
Interesting. Sticking with the housing theme and where we are today, how are we looking overall for the demand in the coming years of housing and how that's going to play into eventually interest rates coming down, more product coming onto the market? But I got to think demand for new housing, just from a population increase, certain amount of destruction that always happens every year in housing.
Yep.
I don't know that those two are going to balance out.
Yeah, there's short-term demand and then longer-term demand, and they're very different. If you look at metrics, and I look at two reports for short-term demand. I look at the Purchase Loan Application Index from the Mortgage Bankers Association, which is people that are applying for loans so they can buy a house. And I look at the pending sales report that comes out from the National Association of Realtors. These are contracts that have been entered into, but the transaction hasn't closed yet. Both of those are off by about 30% year over year. So short-term demand, because of pricing, because of the high cost of financing, and candidly, because credit is tightened up from a number of these lenders. It's harder to get a loan. The short-term demand is pretty bad. Longer term, things look a lot rosier. We have the largest cohort of young adults between the ages of 25 and 34 that we've had in the history of the country. The millennial generation has been reported, is larger than any other prior generation, including the baby boomers. So as these young adults come of age in terms of forming households, they need to live somewhere, and they're all rapidly approaching that average age for first-time home ownership. So and the research suggests that all of these folks coming of age overwhelmingly would like to be homeowners, much the same as prior generations. So long term, the prospects for home ownership demand are very, very strong, and we probably have more of it right now if it weren't for some of those headwinds we talked about. Now those folks will largely rent until they can afford to buy, so that does provide opportunities for rental property owners. And we've actually seen a flood of apartments in construction this year. We could have as many as a million apartment units come online during 2023. So that'll sop up some of that demand. But your older renters, your renters with families, very often really would prefer a house. So again, opportunities there for single family rental folks. And the builders, candidly, they've admitted it, aren't building enough to make up for the lack of building over the last decade. They underbuilt for more than 10 years. They're not going to ramp up too quickly because they're concerned that there's not quite enough demand if they really turn the engines on at full throttle. And candidly, with limited supply, they can keep prices high. So it's going to be an interesting dynamic for the next few years, but it really is probably going to be something that takes 3-4 years to settle out.
Interesting. You mentioned the multifamily housing. We haven't touched much on that today. And certainly there has been a lot of discussion about just the raw number of units coming on in multifamily across a wide geography of the United States, north, south, east, west. Do we have a handle on when those are hitting the market and what the outcome of that is?
And not specifically on when all that inventory will come online, just sometime during the course of the year. And some of it's already in place. And it is geographically dispersed. It is also likely that in some markets, the builders will have overshot and will wind up with a little bit too much supply, which will be good for renters because that typically results in rent prices stabilizing or coming down a little bit. The other thing to point out is most of the inventory coming online is what the industry referred to as Class A units. So they're at the more expensive end of the equation. So that's not necessarily going to do a whole lot for affordability for renters. But it might open up some of the less expensive units as people move up into some of the newer ones.
Yeah, and I guess just to wrap up today, any predictions on fourth quarter on how we're going to see some of these big macro numbers change, whether it be listings, overall interest rates? Is it going to be more of the same for the rest of the year, Rick, or are we expecting any changes at all?
Well, the challenge we have is even if the market metrics, the market economics change for the better, we're fighting seasonality issues. Typically, you have fewer listings in the fourth quarter because nobody's buying. And so I think you have these kind of countervailing forces at play. So I don't expect a booming housing market in the fourth quarter. I do think it'll feel a little bit better. I do think we'll probably see inflation numbers settle back down. I think the Fed might be able to change its posture to make it a little bit less aggressive, which might settle the financial markets down. We might see mortgage rates start to come down a little bit. So I think we'll feel a little bit better, but I don't think the numbers will change materially. Fourth quarter year over year might look a little better than maybe the second quarter did on a year over year basis when it comes to home sales and inventory and pricing. But I think really 2023 as a year is going to be looked back on as kind of a tough year for the market. And I know a lot of people are already looking forward to 2024 for a fresh start.
Without a doubt. Well said. Great catching up with you today, Rick. Thanks so much.
Thank you, Jeff.